you want a good return on your investment, equity is the way to go. While this may or may not always be true, there is an asset class that is believed by experts to be better than fixed deposits. And this investment option has been a hidden gem among other well-known investment avenues. It is called G-Sec strips, or separate trading of registered interest and principal securities, a perfect option for low-risk investors. This instrument acts as a zero-coupon bond and offers about 100 to 150 bips more than bank deposits. For this, I am joined by Hemant of Wiseinvest Advisors to discuss more about G-Sec strips and how can one invest in them and why this option supersedes most other investment instruments. Hemant, welcome to the show. This sounds slightly complicated, but when we talk about G-Sec strips, widely accepted and invested in the US and the Western markets. When we talk about India, a lack of awareness is one of the issues where people don't know about this investment instrument. Let's get down to the basics and let's break down this sort of investment. What are strips? What are G-Sec strips? And how can one invest in it? And when we talk about low risk, does this also mean low returns?
Well, Kavita, you're absolutely right.
And when we talk about low risk, does this also mean low returns?
Well, Kavita, you're absolutely right. What we have seen is over the last maybe year or so that there is an increasing interest from the retail investors in the G-Sec, and this is an option when we talk about G-Sec strip, which I think has the potential to be in the portfolio of all those investors who are looking at kind of safer investment, at the same time looking at a return which could be better than a fixed deposit that you get. So these are essentially, I would say, debt instruments which are created through the process of coupon stripping. So in a way, I think it'll be right to say that these are like any other government securities. The difference being that the interest portion is separated from the principal, which means that as an investor, you have the option to buy a strip created out of interest portion or from the principal portion or both. And I think it's equally important to understand that the strips are created out of existing securities. No, they're not like available through auction like other securities. Let's understand this by way of an example. Let's say when rupees 100 of a government securities, which is offering you 8.6 and maturing in 2028, a strip. Okay, every cash flow of 4.3, because the interest rate paid on a half-yearly basis, every cash flow will be a coupon strip, and the principal which will be paid back, let's say 2028, which is 100 rupees, that's the principal strip. So this is how, from a security, you will have a multiple coupon strip, and then you have a principal strip. A couple of important things, I think again, it's important for every investor to understand that all these government securities which are transferable and are eligible to be a part of SLR are eligible for stripping or reconstitution. So I think this is very, very important. And as you rightly mentioned, once it happens, it takes the form of a zero coupon bond. So clearly, this is a great option, a simple option. It's just that as an investor, we need to kind of really understand this. And this can definitely find a place in every investor's portfolio who's looking at a conservative option, at the same time looking at a better return than what they get elsewhere.
Okay, so how do we go about it? What kind of investors first should be investing in it? Do we need a demat account for this? Are there any minimum to maximum range of investment that we should be going on when we talk about strips?
So I think here again it works in the favor of, I would say, even retail investors, because you can invest as low as 1,000. Of course, you would need, because it's created out of existing government securities, you would need a demat account, the same demat account that you usually use for buying stocks. And of course, you need to have a demat account, a trading account with the broker if you want to start including this instrument in your portfolio.
So, we need to have a demat account to buy these G-Sec strips, but from where can we buy them? And when we talk about interest on our principal, does this keeps changing? Is it something like a bond that keeps getting issued and the interest and the coupon rate keeps changing? How does that work?
Well, I think these securities are listed. So clearly, as you buy, like I said, You use the same demat account as you use for buying stocks. And in a similar way, you can buy these strips through your demat account and a trading account that you have with the broker. I think you asked me a very important question in terms of the interest. Like when we talk about this security taking the form of zero coupon bond, which means that there is no interest component, which is, I think, very, very important for every investor to understand. So what happens is that you buy a security at a discount, and at the time of maturity, be it principal strip or even the coupon strip, you get a face value at the time of maturity. So the gains that you get come to you as a capital gain. So obviously, if it's a longer term gain, which is more than 3 years, is get taxed at, you get an indexation benefit. And if it is a short term capital gain, it gets taxed at your applicable tax rate. So this is different because interest that you earn otherwise gets added to your income. This comes as a capital gain for you. I think so. Even in terms of taxation, this can be a better option.
And how are they taxed?
As I said, this is treated as a capital gain. There is no interest component.
Perfect. But then how volatile would the price be, and what would be the potential risk of investing in this kind of an instrument?
Well, of course, there are two sides of every investment that you make. As we know, the government securities, if you hold till maturity, they're absolutely, I think in terms of they provide you the highest safety. But during the interim, till the maturity, there can be price volatility based on the maturity and how the interest rates are moving. So clearly one has to be aware of this fact that there can be a price volatility. But then if you're very clear in terms of your time horizon, and if you buy securities accordingly, then I think you can tackle it to a large extent.
What about senior citizens investing in this kind of an instrument, because the risk appetite is comparatively less, and also it's government security that we are talking about, where the trust factor is definitely more as compared to other financial instruments. Would you advise a senior citizen to go for this?
Well, I personally feel that any conservative investor who's looking at option and is very clear in terms of the time horizon that investor may have, including the senior citizen, I think they can buy it. We talked about various steps being created from the coupon as well as the principal, which means that periodic maturity is there, and then obviously there is a long-term maturity. So even if you are someone who is about to retire in the next few years, or if you're a retired person and you're very clear in terms of how your requirements are going to be, so you can definitely invest in these instruments and then match the maturity of that with your requirement. So clearly, as I mentioned earlier, in terms of safety, they are got the highest safety as far as all the investment options are concerned. So definitely, even the senior citizen, provided they already have a demat account, are well versed with how to buy securities from the stock market, can definitely go for this.
What are the common timelines of maturity period for strips, and how can one actually mix it with their financial portfolio and for their financial goals?
Well, I think there are a number of maturities which are available to you. Now, let's take a couple of examples in terms of what kind of yield can you get and how these can be included in the portfolio. Let's talk about a security which is, let's say, maturing on 16th September in 2024. So if it's available at 86.60, your yield is going to be around 6.6. So if you need money in 2024, you can definitely go for this. Then let's talk about a security which is going to mature on the same day, let's say in 3030. And if it is available at 55.83 around or thereabout, the yield is going to be around 7.5. Again, if your requirement is going to be in that year, you can look at that. I think it's important to match the maturity of the security with your requirement so that you can avoid the volatility that you may have to face in the interim period.
Comparing with fixed deposits, what are the parameters that you would find strips better than a fixed deposit?
Well, I think there are a couple of reasons why I feel that this can be a better option. Like one reason, obviously, as I mentioned, I think they provide you the highest safety. Even in terms of return, I just gave you an example. Of course, this can change the gap between what a fixed deposit will offer and what these strips will offer can narrow if the interest rate keep rising from here. But definitely, there is a potential to get higher return than what you get from fixed deposit. I think the most important benefit apart from these two is that there is no reinvestment risk. So when you put money in let's say fixed deposit and you're not very clear in terms of your time horizon, or you let's say invested for a year or two, At that point in time, when you want to reinvest your money, it's quite likely that you may actually have to kind of opt for a lower interest rate. So in that case, because here these are slightly longer duration and you lock your money, there is no reinvestment risk, which I think is a great advantage for anyone who's trying to compare this option with fixed deposit.
One thing, Hemant, which I want to understand, we are in a rising interest scenario where even fixed deposit right now are looking attractive because the rates are going up. Even then, you think strips are a better option, or they are at par with the rising interest rate scenario?
Well, as I mentioned earlier, that since we are in a scenario where the interest rates are going to rise further, the gap between what these strips are offering and what FD will offer, maybe it will narrow down. But I still feel that they may still be at an advantage in terms of what they can offer vis-a-vis the fixed deposit.
Rising inflation, that is one risk, and which is why we always advise our viewers to have a diversified portfolio where they obviously can beat inflation. What about strips and fixed deposit? Obviously, I think it's a similar kind of product that we're talking about. Beating inflation and getting a return beating inflation, is that a problem with strips and fixed deposit?
No, I think, again, look, there are a couple of factors that you need to look at. You have various products in your portfolio. Okay, now you're not looking at beating inflation from every part of your portfolio. What is important for you is that overall your portfolio return should keep you ahead of inflation. For the portion that you want to be very conservative and you don't want to take a risk, as we discussed in detail, I think these can be good options. Of course, there are other options also which can be looked at. But I think in terms of staying ahead of inflation, you need to look at overall what is your portfolio mix. It's not that you're investing 100% in this. There are options of maybe looking at some of the mutual fund option, like hybrid option, even if you don't want to go 100% into equity. So I think the key is to have the right kind of combination, which overall can help you beat inflation.
Right. So, if you're a conservative investor and you are looking for some steady amount of investment return, G6 strips is a new option for you where you can line it up with your financial goals and place it in your financial portfolio. With this, we will slip into a short break, and right up we have callers who want to ask their questions, their financial planning questions that will be answered by Hemant Rustagi and Amit Kukreja. Welcome back to the ET Money Show. On this segment, I'm joined by Hemant Rustagi of Wiseinvest Advisor, as well as Amit Kukreja, founder of Amit Kukreja Advisory, to discuss a few queries we have received from our viewers about their portfolios. Good evening, Amit, and welcome to the show. We have this first query for you, which is from Pallavi Rao, and she is into a private job, and she started an investment journey in 2017. You have the funds detail, but then I'll just give you some more details on her large cap stocks, that is direct equity. She has around 11 lakh. PPF, she has the investment amount of 7 lakh, FDs of 12 lakh. She's also put some money in her her husband has some property of 13.5 lakh in commercial. That's a commercial property she's talking about. Her portfolio has the portfolio value is around 4.7 lakh and 6 funds, if I'm not wrong, and these SIPs are mostly from 2020. That's when they started. Yeah. Amit?
Yeah.
She wants to know about her portfolio and maybe her fund mix.
Sure. So my first question to Pallavi is that how come she's not contributing towards the household expenses? She has written that she doesn't contribute, she does only investments. So from the couple's financial planning point of view, my first suggestion is to have an understanding with respect to expenses as well as investments, contribution by both the partners. Because in the eyes of Income Tax Authority, you are two separate PAN numbers, and you should take the advantages of tax deductions and investments on the basis of your contributions. In terms of portfolio specifics, Kavita, I would say, given her numbers that we have, she has about 32.5% equity allocation through stocks and through equity mutual funds. She also has 39.42% fixed income allocation through her PPF and fixed deposits. And she has about 28% in real estate as an allocation towards a commercial property that she's talking about. So if she is in a 30% tax bracket, I would suggest she can move money from fixed deposits to debt mutual funds. Debt mutual funds are more tax efficient if you have a holding period of more than 3 years than fixed deposits. Plus, they might get you about 50 bips extra return if you play it out well, given the risk reward ratio it carries. Then on the mutual fund side, I would suggest she's more into direct stocks and less into equity mutual funds. We don't have information about her experience and about how she picks these stocks. So if she is relying on an expert, then it's a different decision. But if she's choosing stocks all by herself, then I would suggest to increase her allocation more towards equity through mutual funds rather than stocks, because stocks can turn out to be risky. And once she has a decent, let's say about 20-25% through mutual funds, then she can have another 10% through stocks. Fixed income allocation is fine, no suggestion, but she can take more risk if she has the risk tolerance. And the other thing I would like to call out to Pallavi is that she should definitely attach this portfolio to a financial goal. A financial portfolio without a financial goal can lead you to a lot of actions and activities in a portfolio just for no major reason, and you could be very driven by ROI. If you have a goal attached to it, you can be more balanced, more focused investor, and you can really leverage your portfolio to achieve your financial goals faster. That's my few suggestions for Pallavi, Kavita.
All right. We move on to Ejaz, and he's from Mumbai, and obviously the portfolio that he's made, Hemant, is long-term wealth creation, and he has Axis Growth Opportunity Fund, he has Parag Parikh Flexi Cap, Kotak Multi Cap Fund, Quant Active Fund, Canara Bank Small Cap, and PGM Small Cap. He wants to know about the portfolio, and he has some query on redeeming his amount and reinvesting.
Look, Kavita, I think there are two important things. What he has mentioned is that he is an aggressive investor. Of course, he's young, he can afford to be aggressive, and he wants to build wealth over a period of time. So obviously, he has built a portfolio of equity fund, which is perfectly all right. As we know that equity as an asset class is aggressive. So, if you make your portfolio very aggressive, there is no guarantee that you will get return commensurate to the kind of aggression that you show in your portfolio. So my view always is to, I think, create a balance between risk and reward. What I see in his portfolio, if I were to analyze his portfolio now, there are 2 small cap funds and 2 multi-cap funds. Now we know that as per SEBI's definition that every multi-cap fund has to invest at least 25% of the corpus in each of the segment, like large cap, mid cap, small cap. So you have 2 funds where already 100% exposure there in small cap. Then you have 2 multi-cap fund where again, 25% each is invested in small caps. So I believe that there is a lot of aggression in his portfolio. He needs to tone it down a bit. I don't see any mid-cap fund in his portfolio. I think there is definitely a scope to include a mid-cap fund in the portfolio instead of a small-cap fund. Now, for example, he has this PGIM small-cap fund. He can look at PGIM mid-cap opportunity fund again, a high-quality fund. The fund has been performing very well. It's a good portfolio. So I think that's one change I would definitely recommend in his portfolio. As for his second query, whether it makes sense to kind of book a capital gain of 1 lakh every year to take benefit of the exemption, or you should redeem it closer to when you are about to complete your time horizon. Well, my view is if you're a long-term investor, you don't want to disturb your investment process unnecessarily unless there is a need for you to rebalance the portfolio. But just for the sake of booking capital gain, trying to take advantage of that may not be a great call actually. The reason for that is that if you book profit of, let's say, book a capital gain of 1 lakh, your redemption amount is going to be much higher depending on what kind of gains have you made. So for example, if you are in a scenario where to take a benefit of 1 lakh capital gain, you have to, let's say, redeem units worth 6 lakh rupees. Now, which means that there is going to be a time lag from the time that you redeem, by the time you get your money and you reinvest that money. You will definitely reinvest because that's your intent to build a corpus over a period of time. Now, the moment the money comes into hand, there can be a tendency to, if the market is volatile or if the markets have moved up, to start wondering whether I should be investing that money or not. I think you don't want that kind of uncertainty. The second is you're taking a risk of market timing. So by the time you invest your money, if the market has moved up by 2 or 3%, so the very benefit that you were thinking of taking of saving some capital gain you would actually end up buying at much higher levels. So my recommendation is not to get into this practice. If you need to rebalance your portfolio, by all means do that. Now the rebalancing can be from the asset allocation point of view and also within an asset from large cap to mid cap or some such thing. So I think if it is to be done only for rebalancing, please do that. But again, not every 6 months and 1 year. But I don't think the tendency of booking profit every year just to get the benefit of 1 lakh tax exemption, I don't think it's a great idea. Should stay away from that. All
right, a quick portfolio check of Rahul Pandit. Amit, you've got the fund's names. Now his goals, he looks like he's lined up his goals really well. So he needs 1 CR by 2037, 1 CR by 2040, 1 CR by 2042 and 1 CR by 2045. 4 crores, and that's the timeline for you. You think the kind of investment he's doing, he'll be able to achieve this?
So Kavita, I'm looking at his portfolio and the numbers. So to achieve 1 crore in 15 years, he needs an SIP of 18,000. Then to achieve another 1 crore in 18 years, he needs an SIP of 11,350. And then another 1 crore in 20 years, and he needs an SIP of 8,500. And then another 1 crore in 23 years, he needs an SIP of 5,600. All this adds up to about 43 to 44,000 rupees SIP on a monthly basis. He has chosen good equity schemes. I don't have any changes recommended for his portfolio. He's doing well, and he has taken good performing schemes. And based on annualized assumed rate of return of 14%, I am suggesting that he needs 44,000 of SIP, and he's doing 24.5 thousand SIP, which means he's short by approximately 20,000 a month. So he can tone down his expectations or the goal amounts, or he can deprioritize one of his financial goals, whichever he thinks is possible. Otherwise, from a scheme point of view, it's a good portfolio that he has created. From the allocation to large cap, mid cap, multi cap, and also small cap, he has not gone overboard with any particular market cap category. So he has a balanced portfolio, and he's taking full advantage of equity allocation completely through his set of mutual fund schemes. So only expectations he needs to reset about himself is how he can increase the SIP or reduce the financial goal target amounts.
All right, last query of the show, and Hemant, this is from Leona D'Souza. She says that she's a homemaker without a lot of experience in finance, and her family gives her monthly expenses, which she saves, and now she wants to start her investment journey, and that's the cue for you. How should she go ahead?
Well, my recommendation is, if she really wants to start her investment process, is look at mutual fund as an option. Because there are many advantages of investing in mutual fund as compared to other options, be it in terms of diversification and the fact that you have professional fund manager managing your money. And the best thing about mutual fund is that there are options available for a beginner as well as for experienced investor. And if the intent is to invest for a longer period, maybe you can start through SIP in equity fund. And it's a very simple process to start. You need to do your KYC done, which you can do it online or offline. Even investment can be done either online or offline, either through the mutual fund or a distributor or through an online platform. So it's very simple to kind of start your process. 2 funds I'm recommending to her. One is Nippon India Large Cap Fund, because again, I think it's important to not make portfolio very aggressive. And the second is Kotak Equity Opportunity Fund, which is a large cap and mid cap fund. Both these funds have long established track record. Begin with this, begin with a small amount. It'll make you a better investor over a period of time. Once you understand the nuances of investing in equity and equity funds, maybe you can increase your investment, but begin with mutual fund. I think that will be the best option.
All right, so that's the recommendation for Leona, and that will be all on the show today. Thank you so much, Amit and Hemant, for participating and giving your recommendations to our viewers for their financial portfolio. And with this, it's a wrap.